This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and our personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today is episode number 45. Today, I want to introduce you to one of my dear friends, Johnathan Mills Patrick. Now, let me tell you a little bit about Johnathan. Besides being a proud husband and a father of a beautiful family, this guy is like the banking wizard. All right. Johnathan is a former C-level executive in the banking industry. He's actually has a marketing degree and has run marketing departments for $230 million organizations. That just blows my mind, dude. He has helped entrepreneurs raise more than $500 million between both debt and equity facilities. Now, look, he is a 3-time startup founder, like yours truly here. He knows what it's like to start a business. We have lived this race. We've laughed through the years. We've seen some things in our own businesses through the years. He has been recognized as a top executive in his industry in 2014. I didn't know this one about you, Johnathan. I didn't realize you were a former financial advisor.
I was.
I did know, though, that you're an author, and we're going to talk more about your books and your courses and things. Now, look, he has led the top SBA lender. We're going to deal a little bit with the SBA today in our state, Tennessee, for 4 consecutive years. So enough about his business side. Get this. He's a full marathon runner. I remember when you were training for that crazy thing, dude, just to watch you in the endurance. But probably the one thing that's like, don't mess with my friend Johnathan is this guy was the 1996 state karate champion. This guy is like bad to the bone. So, dude, with that introduction, Johnathan, I'd like to welcome you, my friend, to the Financially Simple Podcast.
I'm thrilled to be here. Thank you.
Let's jump right in, man. So we've been dealing with starting up a business. And as you and I were talking pre-recording here, a lot of people are reaching out to me saying, Justin, man, I know what it's like to start a business, but how do we do it? Where do we get the money from? So I've got you here on the show, Johnathan, to pick your brain. I want to dive deep. You know, it's financially simple, so we got to keep it simple for me. Remember, I'm the dumbest one here in the group. So break it down easy for me. But I want to jump into the very first question. How can business owners who want to start a business find funding?
So I think the key, Justin, that I always try and do, and I think my model's similar to yours, it involves a lot of education. Just got off the phone earlier today educating an entrepreneur about it. And I think the struggle for a lot of entrepreneurs is they just don't understand what path they should go down in the first place. Funding always kind of feels like voodoo. You know, what is going on? What are these people asking me? Why are they asking me this? Why does it matter? There's just this big mystical thing around obtaining funding. And I think when you break it down to its most simple components, it's a lot about understanding which route you should go first. So we can break that down simply into loans or investors, right? How each one of those categories looks at a startup opportunity, why they ask you the questions they ask you, and what their appetite's going to be. A lot of startup founders run out and they shotgun their opportunity out to anybody that'll talk to them. I get it. But really, when I work with folks, we try and be very rifle focused and we say, which path makes the most sense? And within that, which of my contacts and maybe theirs make the most sense, have the most appetite? So it's just being really strategic with startup funding. The other thing with that I try and educate founders on is understanding how lenders and investors look at the world. And if I could break it down financially simple for folks, it comes down to understanding that lenders are historical looking and investors are futuristic looking.
Okay, let me pause you right there. Let's put some meat on this bone, okay?
Let's do it.
So let's pretend we're going to name a business. And, you know, I've got a water bottle here in front of me. We're going to pretend we're going to open a water bottling company for this illustration. We're going to use this illustration throughout this whole interview. Let's say that I have a company and I have this idea. We've already gone through the business plan. We just finished up the episodes on that, and I put together the business plan. I know that this company is profitable. How should I approach going forward to lending? So let me give you a little bit of more information that I know you'll need. Okay. Let's say I'm a sole proprietor. Okay. Mm-hmm. My finances look good. I've got a decent credit score. I don't have a lot of debt. I've got a little bit of money set back, enough for the business plan to say, you know, I can get about 12 to 18 months through my business. Okay.
Right.
So I've got a good little solid cash position. I have to purchase some equipment, obviously, for my bottling company. I've got some pre-sale contracts out there in place. How do I make this business move from a paper business on a business plan now to reality through lending?
Yeah. So again, with lenders, it's understanding what they're looking for out of your model. first of all, the biggest thing to understand is the one thing they care about is proving the ability to repay. So cash flow. Can you pay back this loan? And any good lender, at least the ones that I have been at in the past and the ones I try and work with now, any good lender is going to take a look at that from a global perspective. What's all the income that you have coming in? What are all the expenses that you have? That's where a business plan comes in handy when you're showing it to a lender. You're saying, here's what I expect my revenue to be. Here's what I expect my expenses to be. If you've been in business a while, you know that they're going to look at your tax return to get that historical look to say, what was your income? What were your expenses? And then they use that to kind of get a sense of, do we think this will continue on? Will there be a small growth curve? Is that industry diminishing a little bit? Those type of things. So the biggest thing to understand about working with lenders, especially if it's new, is proving you have the wherewithal to pay back that loan. That's why they use the projections in the business plan.
So you've put me in a position here where we have a fork in the road, okay? Mm-hmm. So you mentioned that they're going to look at back tax returns. Is it to say that lenders don't traditionally work with startups from a banking perspective? And if they're really not funding for startups, where does a startup then go? Not through the lenders.
So the vast majority of what we would call traditional lenders, I'm going to group banks and credit unions together since I've been at both. Most of them do not do what you and I would call startup loans, where it's ideation only and or the founder is not even formed the operating company. There's zero revenue coming in. Most of them won't do it. If they do a business loan to that individual, it's usually just based on their personal existing wherewithal, not where they're going, but maybe they have a day job. They've got some assets they can use as collateral, those type of things. Now, you might remember when I was at an institution, we did a startup loan program called the Line 12 program.
Right.
That was for ideation only startups. So there are more institutions that are going that direction to do those types of things, but it's very limited right now. One of the great ways, and we don't have to touch on this now, we can come back to it, but one of the great ways for someone who is in true startup mode that wants to get a loan to go that path is I encourage them to seek the SBA guarantee through one of their lenders that they work with.
Well, let's jump into that. Let's pull away for our conversation for the sake of time. And if we have to have you back to talk about the second branch here, let's not jump on today's conversation, the established business right now that's going to go get additional money. Maybe they've been working out of their vehicle. Maybe they've had some, part-time job while they're trying to get the business off the ground. Let's deal strictly with that startup, okay? Because I know that your background is in the SBA, and I've mentioned them several times on the show. Mm-hmm. I know we have the SBA. I know we have things like angel investors and all these others. Let's take from a startup position, Johnathan, and take our water bottle company, and I have a little bit of cash, enough to feed my family for a year or so. How do I make my business come to fruition? Is it through the SBA? Kind of walk me through that.
Yeah, well, it goes back to determining what's the best route for you. So trying not to weave around on you a little bit, but from an investor perspective, it's got to be something proprietary to invest in, right? Most investors are interested in high growth. If they've done this before, if this isn't their first rodeo and they like to invest in companies, most of them are looking for high growth startups. They're not looking for lifestyle businesses. I talked to someone the other day that's wanting to start a website like mine, actually. It's a lifestyle business. They produce digital products to resell. That's not something an investor is going to put money in. That's a lifestyle business, right? So you have to understand the difference in the appetite that they're going to want. So investors are a good path to go, but you need to understand what they're looking for. They're looking for a huge growth curve. This also goes back to understanding what each of one of them is after, right? So investors are after equity, lenders are after interest payments. So you have to understand the different paths. And what most people do is they just run down the path of both at the same time. I'm going to get any funding I can. And they waste all kinds of time and energy doing it.
And that segues back on our last episode, folks, about why a business plan is so important. And Jonathan's not exactly saying that, but that's what he's saying, is your business plan is going to tell you which direction you want to head in your lending. So, Johnathan, let me steer us down this path. So let's say that I do want to own a lifestyle business. Let's say I do want to start up a grass cutting business. Mm-hmm. It's super simple. And I need to go out and borrow $50,000 to buy equipment. Okay. And I've been using a push mower from Lowe's for a little while. And I know with my drive and my ability that I'm going to be able to take this business and move it from where I can make $100,000, $200,000 within a 2-year period. How does someone like that, and we'll come back to the actual business where you're not a lifestyle style business, where you have a business that you're not relying on, but how does a lifestyle business person find lending?
It goes back to they're usually focused on their personal wherewithal at that moment. Again, it's hard to get startup loans in general, even if you've got a great high growth startup idea. But for someone who wants to do a lifestyle business, they're really going to focus on where have you been? What's that historical picture? Do you have cash flow coming in from investments? Maybe they work with you and you're doing a killer job as always for them on their investments. They've got regular recurring monthly income coming in. They're using that to live off of. They're going to look at that historical picture for that type of thing. So there's three main things that they look at for loans, even if it's a startup loan. So I think this is true for what you're asking. They're looking for cash flow. So that's the primary source of repayment. The secondary source of repayment is going to be collateral of some sort, right? Do you have some assets I can use as collateral? And the third would be that liquidity. You were talking about having some cash in the bank. Most lenders are not going to give you 100% of the funds that you need. They're going to want to see that liquidity that you have. So those are sort of three key hurdles that you need to kind of think about jumping over when you're going for a startup loan for that lifestyle business or or maybe it's your water bottle business at this point.
So if a lifestyle business, we're going to go to the traditional lending, the bank, the credit union, maybe even the SBA in that style, they're going to look at my personal finance. They're going to look at my credit score. They're going to make sure that I have enough cash in the bank. If I'm buying, let's say I buy $50,000 in landscape equipment, obviously they're not going to be able to sell $50,000 in landscape equipment for $50,000 on the lawn of the bank. They're going to get maybe 10 grand at that for that equipment if they're lucky. So if we're separating business, and this is one of the things that I'm getting ready to harp on in the podcast series going forward, I'm glad you're getting me in this direction. The way I view a business is you have, to me, this is Justin's financially simple mind, and you may or may not agree with me on this. That's okay. I don't view a business as a company that I have to show up and work for every day. Okay. To me, that's a glorified job. It's one with a lot of risk and maybe some reward, but it's a glorified job. The way I view a business in my simple mind is I have a company or a structure in place that doesn't require me to consistently show up. It can actually operate autonomously, perhaps, without me there and provides me income. Is that style business, what I just described, is that what an investor or an angel investor or maybe even a bank might consider lending money toward a little easier?
Yeah, the challenge with that, Justin, is they see that as absentee ownership. As soon as you start telling them that's your plan, is that you're going to start it. Essentially, somebody else is going to have to keep an eye on it, especially the lenders. Actually, lenders and investors are going to sort of back away from that table. They need that founder to be involved early on. Now, I think out of the two paths, the investors are going to harp on that even more and say, listen, you were the idea guy or gal. You need to stay involved in this business. The time for you to step back, we'll let you know when that time's going to be when we bring in a more polished CEO who's going to get it to the next stage. Those folks are definitely going to pull back from this idea of autopilot type stuff, right? Look at Facebook. Zuckerberg's still running it this many years later. He's deeply involved. He's not at the Bill Gates level yet where Bill stepped away and said, new CEO, you go run it because I'm not the person to get it to stage 2. Lenders, it depends. So I've seen business models. So there's a gentleman here in town back a couple of years ago. I helped get financing for a fitness startup here in town. And he was going to be semi-absentee, meaning he wasn't going to be there 24/7 running the business, but he was going to hire a manager to do it. What they look at there, and we've been talking about this a lot, is they went back to those projections and said, does this business show the ability to swallow that kind of expense so that the business owner can stay in their day job since he's earning 6 figures a year and he's going to pay this manager 30? That's a pretty good swap right now so that I feel comfortable you're going to be able to pay me back.
So let me pull it way back to the beginning because I think that's very good what we just discovered. And you've actually just taught me something. And so I appreciate that. Let's take the example, Johnathan, because I had a couple of people who reached out to me and they said, hey, Justin, I've got this great business idea. I'm working through the business plan. Do these projections really matter? Okay. And Jonathan's laughing. You can't hear him, but he's laughing right now because he and I see this a lot. How important are the projections, the financial projections in the business plan to a banker? And are bankers savvy enough legitimately? I mean, we give bankers a hard time sometimes because they never want us to loan us money when we need it. You've heard that saying from many people. Are they savvy enough to know that the projections are either legit or non-legit, that we fluffed them up? Talk to me about this projection.
Yeah, so I love it. I'm glad we're on this. So I'm going to use a bit of a story. You know me, I like to tell stories with that marketing background. So you and I have a friend here in town, Catherine Eaton. She's an accountant. Right. She's my accountant. And she is not an accountant, right? Her personality.
Right. Exactly, most definitely.
She's stoic and she's energetic and all this. Where I'm going with this is I'm not your typical banker, right? There's not many bankers who understand equity finance as well. Right. And we could talk about that another time, why I'm this way. But I'll show you, and then I'll explain it because people can't see you and I talking right now. But I'll show you what bankers do the second they get a business plan. Let's imagine the projections are in the very back. Right to the back, straight to the projections. They don't read a single thing in the business plan, and they look at them. And they look at gross revenue, and they look at cost of goods sold, and they look at net revenue, and maybe they'll glance at payroll or something like that, and they're done. Bankers are smart people. I'm not implying they're not. Some of them are very, very savvy, but the majority of bankers I've known in the past, they can look at projections, and what they're looking at is not if they make sense to your question. They're looking to see if you're going to be able to pay that loan back. So they don't look at it for why you're asking. They're not looking at it as a business owner going, does it make sense? Did they use some research in how they got to these projections? Did they forecast anything? Did they do those type of things? Most people just slap together projections and say, here you go. Whereas me, when I looked at them, I would call up business owners and I would say, I'm curious, you're going to be having this percentage of payroll, or your cost of goods sold shows it's going to be 50% of gross revenue, but in your industry, it's usually 30%. What the heck's going on?
Right.
Those type of things. So no, most of the time, they're not looking at it from that perspective. They don't really care as long as they think you can pay that loan back. That's why they're looking at your projections. Do they matter as much? Sort of the first question, I guess I sort of jumped to two. Let's talk about one for a second. Do they matter as much? They do matter. You know why they matter? They matter for you as the business owner. That business plan is being written not for you. I get it all the time. Help me on a business plan so I can get a loan. No. You do a business plan so that you have a model to work off of to operate your business in the early stages off of. It just happens that we're going to give it to a lender to hopefully get a loan.
So let me take it even further back now, because we've done a very good job of painting out what a lender's looking at. We know how to go about. If I'm a startup, I'm going to go to the credit union or the local brick and mortar bank on the corner, develop a relationship with a banker and say, hey, based on my personal equity, based on my personal assets, can I get a line of credit or can I get a business startup loan? If I'm in a position to where I'm running a business which has high cash flow, I may end up dealing with an angel investor who's looking at a nice return on money versus the ability to pay money back. Let's back way up. And let's say that I haven't been working with a good CFP for years. And you and I see this often. We often run into people who are great entrepreneurs. They have a good mind, but their finances just don't look good. And I know this is a little outside of your expertise, but I know you can handle this. What methods could I, Justin Goodbread, as a potential entrepreneur, employ to help build my bankability up?
Yeah, and I'm going to sound a little bit repetitive, but you got to build up that ability to repay. You've got to build that up.
What does that mean?
So the first ability to repay is cash flow. Do you have the income to pay for your current expenses and this new loan that I'm going to add on top of you? And what they're doing is the bank saying, there's a chance this business may not make any money for a while. Can you handle this loan payment off of where you are right now? So build up the ability to do that. Maybe it's doing some of these side hustle things that I do and that I think you do, or sort of side business ideas to build up cash flow, money in the bank, reserves to live off of so that you don't have to pull money out of this new business that really can't afford to pay you in the first place. Build up expertise, right? So we haven't even talked about that yet, but if you're going to go into business, build up some expertise in your area. I don't know how often you see it, but I see it all the time where it's the proverbial story of the doctor who decides he's going to open a restaurant. You're a smart person, but you don't know a thing about a restaurant. Build up that skill set to be a good entrepreneur. And the way you do that is by getting around mentors and other smart entrepreneurs. So the best way to build up, if you are not in a position that you should be financially to start your own business, is to start hustling. Put some work in, get some cash set aside, get your income levels up to show that you have the ability to pull that off in the first place. That's going to pay huge dividends for your business anyways. So what happens, Justin, is most people want to start from, I have an idea, let me run out and get a loan, because it's the easy answer. I don't have the cash right now to do it. Let me run out and get a loan. The statistics from the Kauffman Foundation did a study with the SBA. Oh, it takes $30,000 to start a business. That's years ago. It doesn't take that anymore to start a business. You can start a business for a few $100, populate a website out there and get to selling your expertise and make some money, and test your model in the first place and see if you can make some money to put yourself in a better financial position to then be able to go get a loan. A loan is not always the right path forward for a startup.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
So I have two more questions. I know we're getting close on time here in our time limit, but second to last question, Johnathan, is we mentioned the SBA and we danced around a little bit. And I know your expertise is dealing with the SBA and you've dealt with that many as your bio we talked about. What is the SBA? Number one, how can it be beneficial to a small business owner? Number two, and then my third question in that series is, when should a business owner avoid the SBA?
Yeah, good question. The SBA is a Small Business Administration government entity that's out there to encourage loans through financial institutions. That's a common myth. Most people think the SBA makes the loan. They make micro loans of their own, but most of the money they put out in the marketplace is through financial institutions of some sort, credit unions, banks, other entities like that. That's why they exist. So that's a common myth. Number one, they don't necessarily do the loans themselves. Number two, in some instances, they don't even approve the loans. So if you're under what's called their Express program or $350,000 or less, most financial institutions can make that approval in and of their own and then just notify the SBA that they're involved. If the SBA is not making a loan, what are they really doing? What they're doing is providing a guarantee to the financial institution to minimize that financial institution's risk, and therefore encourage them to make more loans to folks like startup founders, right? It's a great program. You can go all the way from, $5,000 up to millions of dollars of loans. And the reason I encourage it is, especially for a startup that we're talking about today, is that idea of that guarantee to the financial institution. If you need that $50,000 to get started, and I do an SBA loan as a lender, it's a 50% guarantee through the Express program. As a lender, I'm really at risk what now? $25,000.
Right.
You were talking about the equipment that you bought for your lawn mowing business. You bought it for $50. It's really worth $10 if you have to go sell it at a fire sale. If you're the banker and you take control of it and sell it $10. Well, if I had that SBA guarantee, I'm recouping $25,000 plus the $10 I sold from you. So now I really only lost $15 versus $50.
Right.
So it's an absolutely great program. The key is working with the right lenders who understand the program and are what's called preferred lenders. So they have that ability to approve the loans in of their own accord.
So when should a business owner not use the SBA? When do they run against an adversary to the business owner?
Yeah, the easy answer for that is when you're pretty well established and you don't need it. If you don't need it in the first place. And the reason is the SBA does, to cover their costs, add a few additional fees. It's not anything dramatic where people should be scared of getting an SBA loan, especially if you need that guarantee to get your loan done. You're going to be willing to pay that extra fee. But the SBA will add anywhere between 1% and 2% fees on top of your loan. And the bank may add what's called a packaging fee to put that loan together because there's extra work involved in forms and stuff, maybe $400 packaging fee or something like that. If you don't need the SBA guarantee, then there's just no reason to go get it.
Gotcha. So here's my question that I ask everybody. With your knowledge and expertise, what is the one question that I should ask you that people don't often ask you? And that's that's my hey, you shot me on a question whenever and I'm going to let you think about this. So folks, Johnathan Patrick has a podcast and he asked me a question that he's like, and I had to stop and think about this. And I said, I can't wait till I get him on the podcast. I'm going to give him that question. It's going to make him stutter. And I don't get to hear Johnathan Patrick stutter much. This guy's razor sharp. This guy's razor sharp. He never stumbles. I'm like, I can't wait. So I just had the opportunity, folks, to get Johnathan. So let me ask it again for you while you're thinking about this.
Sure.
What is that one question, Johnathan, that me as a business owner should ask you that is failed to get asked, that you wish people would just ask you this question?
Yeah, I wish they would ask me, and I'm actually going to steer away from what we've been talking about.
That's fine. No, go ahead.
I wish they'd ask me, how do I know if I should go into business for myself in the first place or not?
Wow, that's powerful.
Now, my first thought was they should ask me, should I go into business for myself in the first place?
It's a little off topic, but hey, let's do it. I want to hear your thoughts on this.
Yeah.
How would you answer that?
Well, you have to be willing. So listen, we've known each other a long time. Mm-hmm. We're getting older. Gray's coming in for me, at least.
I'll shave all mine off. So you
all right. I think we're getting a little more introspective as we get older, and I think you get wiser. And, I can remember the way I got into startups was I was a commercial lender and I had all these startups coming to me for money. And I kept telling them, no, we can't do loans for you. Right. So I wanted to learn how that worked. And so when you get around startups, you get these own startup ideas of your own. And so I did my own startup in 2010. I did my own startup for all the wrong reasons. I wrote about it in one of my books, right? I wrote Lessons of a Failed Startup. I mean, to everybody else, we didn't fail, but to me, it was a failure.
Right.
I talked about this in the book. I didn't do it for the right reasons. I did it because I bought into the hype. Today's startups, especially the big ones, they're celebrities. Right. Everybody wants to, we see it on Shark Tank. We think, how amazing. They just got $2 million from Mark Cuban. I'm going to go do that myself. You don't know what you're signing up for, number one. Right. It is going to be a slugfest. That hobby that you think you're going to turn into a business, right? It's not going to be a hobby anymore after you're doing it for 14 to 16 hours a day.
Yeah.
You need to stop and look in the mirror and be willing to do a hard assessment of your skills and abilities. I'm in between startups right now. Got another that I'm looking at getting involved in, but I'm in between right now. One of the reasons I haven't jumped into another one right now is because I've been looking in my own mirror saying, are you really right for startups in the first place? Now, Justin, you know me, so I think you'd agree with this. But the best value I add to someone or to business is very high level strategy, right? All my mentors tell me you're the guy who can take A and Z and make C out of it when nobody else could do it.
Right.
You know what I'm not? I'm not the guy at the detail level. That's not me. I'm really great at coming up with the idea, but when it comes to putting that all into place and driving it for 3 to 5 years, I get bored and I'm not good at it. I think I'm smart enough I could do it, Justin, but I know where my highest strength is up here.
Right.
People need to look in the mirror and say, am I that person? Maybe I'm just the idea person and I'm great with coming up with these ideas, which by the way, there are no unique ideas in the world. We'll talk about that another time.
Yeah.
Maybe you're a great idea person. Maybe you're not the right person to drive that business forward. And so you got to look in the mirror and say, should I go into business for myself in the first place? How am I going to feel after 6 months of zero results? Will I be willing to keep going? Because that's what it takes.
So that's interesting because I was in a board meeting this week here in Knoxville, and if I named the board, you would easily recognize it. And one of the members of the board just joined, and he's in about a 6-month phase of a startup. This gentleman had been in business in the corporate world for 30 years as an executive, very sharp, very, very sharp individual. In fact, may know this individual, but just super sharp. And he decided he was going to start his own business. And I chuckled because he said, I have an MBA. And I started laughing right off the bat because most people with MBAs aren't startup type personalities. And here he is about 4 months into the business, Jonathan, and he is struggling. He has not been able to pull off his technical business plan, air quotes there, folks, for those of you listening. But most MBAs, they think they have the knowledge to do it, and they end up getting kicked straight in the teeth.
MBAs are all about theory, not practice.
Well, and that's what happened. He was talking to me offline. He said, Justin, I'm 6 months into this. How in the world have you started business and made successful? I feel like every day I hate getting out of the bed. And Jonathan, I personally dealt with it. You may know this. I don't know if I've ever shared this with you. I started a business, a landscape business that I sold when I was 23 years old. I took the American dream, something I loved, which is to me horticulture. And it turned into a job. It turned into a babysitting job. And I hated it, man. And I was able to get off the ground, but I could never grow it to make it sustainable for long-term family, multi-generation because I hated it.
Right.
So it's not only the introspective of can I start it up, but it's also am I going to have the passion to continue it, to grow it, to create a business?
Listen, you talked about my MMA background. You know, one of the things I learned is get knocked down and get back up. I'm like a tank, man. I just keep rolling, right? I mean, my wife laughs about it all the time. She's like, there's like a brick wall in front of you and you run through them all the time.
Yeah.
But you know what? That doesn't mean it's going to translate to the startup world for me. Just because I'm that way in some aspects, just because I'm really good in the corporate world doesn't mean it's going to translate in the startup world or vice versa, right? I mean, this can go all kinds of different ways for people. Don't drink your own Kool-Aid. Oh, this is a brilliant idea. I've got it. This is the next Facebook. You're in trouble, everybody else. I've got it. Wrong. Most likely you didn't do enough research and it already exists. You just need to outcompete. Again, topic for another day. But you got to be willing to look in the mirror and ask those hard questions and realize this just may not be your thing. Or Justin, maybe you're not right as the founder, but maybe you're right as the co-founder. Maybe if you have a co-founder, you operate well in a model like that. Some people don't.
Right.
And maybe that's the path for you to go forward in this business. What I really like people to do, and this may be bad advice, but what I really like people to do is piddle early on.
Explain that.
I want them to piddle and try different things. Try different small, inexpensive business models to get into. Maybe write a book and see if you're good at marketing and selling it. Maybe take on some consulting clients at much less than you're willing to typically get paid because you want to experience what that model's like and grow your skill set along the way. Try lots of things. You've known me a long time and you and I would both agree that I've done lots of different things over my professional and startup career, right? I've tried lots of different things. Looking back now, you would have never thought all those things would have came together to put me in the position I am in. God did that. I didn't do it. Right. You would have never thought that would happen for me. All these different things, how they add up to where I am today. But what they did is they added skill sets I didn't think I have. I mean, I launched my own websites now. They're probably not top notch, but they're pretty good.
Yeah, they're good.
You know, all these different things, just learning these different things, learning content marketing, learning all these different things. Go out and piddle at something and see how it goes. If you lose interest after a couple of months because it's hard, you probably don't need to go into what you and I are calling the startup world.
So, Jonathan, you made the statement a couple of times now, self-assessment. How would you advise people on doing self-assessment along this idea of startup? Is it you go in and piddle a little bit? Is it to where you're having consultants maybe throw daggers through your particular ideas? Is
Right.
it, I don't want to put words in your mouth. So
you're right.
what's your thoughts?
Yeah, so I first want to clarify, I think there's a distinction between piddling at different things and then validating an idea. There's a difference. Validating is very big in the startup world. You need to validate that business model.
Right.
I'd actually like to talk to the validation side if I can about that. The other side, piddling and just testing different things, it just allows you to learn and see what you like to do if you don't already know. But let's talk about validation for a second. You do what you talked about. I actually just got done blogging about this, Justin. What you don't do is you don't go and validate your idea with your mom, because you know what?
Right.
Most moms love you and they're going to tell you this is the most brilliant idea they've ever heard in their life.
Right.
And you don't do it with your best friend. It's okay to talk to these people about things, but go out and find people who are going to challenge you about your idea, who are going to tell you you are absolutely wrong, this won't work. Because as soon as they do that, if you think, and you ignore them, you're doing the wrong thing.
Right. Danger. Also,
you're doing the wrong thing if as soon as they challenge you, you quit. Right? You want people to shoot holes in your idea. Alex Lavage, I forget the rest of his company's name, but he does startup consulting, smart guy, lives in Chattanooga. Alex laughs all the time because I'll tell people that their quote unquote baby is ugly.
Yep.
You want people to do that. I'd rather you tell me that before I go out and spend 10, 15, 20, 30, 50, $100,000 and blow this business because nobody told me it was a bad idea or that there was a competitor I wasn't even thinking about. Get around people who will challenge you on your ideas. That should be mentors. And if you're having trouble finding mentors, Justin and I know plenty of people. Reach out to us. We'll try and connect you with some other smart people. Find a mentor. Smart people to challenge you on what you're doing will help you validate that idea. The other great way to validate, I'm getting a little off track, so I'm just going to say it quickly. The other great way to validate is to try and get people to pay you for what you're offering. That'll do a lot of validation for you.
Explain that.
Yeah. So a lot of people, especially startups, when they go through these accelerator programs and they're taught to validate, they go out, they do market research, and they talk to potential customers. Notice I said talk to. Right. Well, it's easy again for a customer to say, that sounds pretty smart. Great. Is this something you would buy? Sure, I would. But the second you make me write a check, then you really know if your idea is validated.
So let's bring this 360 back to home because I don't think we're actually off topic. Here's where I view this. I've got an idea for a startup. We've just come back and we said, you know what, we need to, I'm going to use your word, piddle, and we need to get some knowledge out there on various things. And that can happen in high school. My daughter's doing a little business right now to raise money for a mission trip, and she is piddling in a little thing, and she's having the time of her life. She actually has people buying a widget from her, these crazy little soap bomb things, and they're like selling faster than she can make them. She's having a blast.
Some validation, isn't it?
She's having some validation, right? So you can start in high school. She's only 12 years old. I don't even know what grade she's in. That's bad, isn't it? So she's piddling right now. Now, when you come out of college, and you're going to start validating at this point, you have your business idea, you have your business plan, you have the forecast, and now you're going to validate that forecast before you ever go see Jonathan at the bank or the Mr. Banker. So now, Jonathan, if I have the experience and I piddled, and I now can build that resume out to say, Mr. Banker, here's what I've done. Here's been my successes, and here's been my failures. Here's what I've learned from those. And here's my business plan, and here's the validation for it. Here's what I've already put in place for the last 6 months testing this. My finances are in order. I'm not in super debt. I have a little cash. Is that a different conversation with the banker at that point than me coming in and saying, hey, I got this idea, let me pitch it to you?
Absolutely. Because what it means is you're pretty serious about this and you've done your homework, right?
Yeah.
Not just, I've got a dream. I'm not against dreams. I love dreams. I do it all the time. But it doesn't make bankers jump up and down excited to give you a loan. So especially if you walk in, Justin, with a purchase order. Hey, I've got a lawn mowing business and I have 15 clients that I start mowing tomorrow.
Right.
That changes the whole conversation. What these are, in my mind, they're milestones. They're small accomplishments along the way, moving up the validity of your business. Investors also look at milestones. They look at these things that you've accomplished that pushes the valuation of your company up and allows you to give up less equity when you raise money. These same things are true for lenders. These little accomplishments along the way that will improve your chances for getting a loan.
So, Jonathan, with that, let's wrap this up because you and I are both out of time. We have a business that we both have to run. Thanks for coming on the podcast. My last question for you is, where can people contact you, or how can they find out about these books you and I mentioned?
Probably the best place to find me is just at my personal blog. My full name, JonathanMillsPatrick.com, is the best way to find me.
Okay.
Check out some of the resources I've put out there. I put those things out there, Justin, for the exact reason that we talked about, which is to educate people. They answer the most common questions that I get so that I don't have to repeat myself over and over to people. I usually would just say, go over here and check out this ebook. It'll answer most of it for you. Give me a call when you're done with it. We'll talk in depth.
And folks, I know I don't probably have to validate this any further, but I've known Johnathan for years. I have seen his knowledge firsthand. I've worked on mutual clients together with Johnathan. I'm going to put a link in the show notes to both his personal blog, JonathanMillsPatrick.com, and also JonathanMillsPatrick.com/ebooks, where he has a list of ebooks. And in these ebooks, he has things like The Ultimate Guide to Funding a Business, which is exactly what we've been chatting about here. He's got things like what investors look for in startups. And these are not expensive ebooks. They're 99 cents, $5.
I'm trying to get rich, just trying to share knowledge.
How to Meet Startup Investors. I don't think I've ever read that. I think I'm actually going to order that myself and read what you got to say about how to meet startup investors. So guys, Johnathan is a great friend, but he's also a wealth of knowledge. And with that, Johnathan, again, thank you for joining me on the Financial Simple podcast, buddy.
Thank you.
Now, for his listeners, I'd like to thank you for joining me as well on the Financial Simple podcast. And as always, today's show notes are going to be on thefinancialsimple.com underneath the heading podcast. In our next episode, we're going to do specific items about kind of what Johnathan was mentioning today. What do you have to do for your personal finances? How can you get personally prepared to meet that banker? So we're going to deal with that in the next episode. If you like the show, please subscribe. Share the podcast with other business owners. If you have a particular question, do like some of our recent ones have done, just shoot me an email. You can do it on the podcast. You can go through Twitter, wherever. Just shoot me something and say, hey, Justin, answer this question for me. On our blog, financiallysimple.com, you can sign up for our weekly newsletter. It's pretty awesome. We're dealing with tax planning tips, business planning tips, wealth management tips, a lot more. And like I say every week, Johnathan, you've heard me say this before, life is hard. Life is good, but life can be frustrating. Money, it doesn't need to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and create a great week.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.